You think you're doing the right thing. Every 2 weeks, like clockwork, you see the money disappear from your paycheck and funnel dutifully into your 401k. You've been told this is the responsible path, the golden ticket to a secure retirement. You've been sold a dream of sipping margaritas on a beach at 65, all thanks to your discipline today. But let me tell you what that dream really is. It's a lie. It's a 40-year sentence to a financial prison, ending in a retirement that will be mediocre at best, and for most, a terrifying nightmare of outliving your money. That 401k you're so proud of isn't a savings vehicle. It's the modern-day golden handcuff, a tool designed by a system that doesn't want you to be rich. It wants you to be compliant, dependent, and just comfortable enough not to question the game until it's too late. Every piece of conventional wisdom you've ever heard has reinforced this lie. Your HR department, the smiling advisors on Wall Street, the so-called gurus on television, they all preach from the same book, a book written to profit from your ignorance. But have you ever stopped to ask how the truly wealthy build their fortunes? I can tell you right now, it is not by maxing out a 401k. They understand the real rules of the money game. True wealth is built on control, cash flow, and owning the asset, not just a piece of paper. Today I'm pulling back the curtain. I will deconstruct this lie, piece by piece, and give you the blueprint they use, the one that leads to financial sovereignty. Let's start with the first pillar of your prison, the company match. It's free money, you've been told. This is the most insidious lie of all. That match isn't a gift, it's a bribe. It's a calculated low-return incentive designed to do one thing, keep you chained to your desk. By convincing you to lock up your own capital for decades just to get a paltry 3 or 4% from them, they guarantee your loyalty. That free money is the most expensive money you'll ever accept. Think about it. That money, your money, is now trapped. It's held hostage in a fund you don't control, unable to be deployed into assets that could be generating real income for you today. While your capital sits idle, earning paper gains you can't access, it could have been used to buy a rental property, fund a small business, or generate cash flow that could actually change your life right now. The second pillar is the fallacy of passive investing. They sold you on set it and forget it as a brilliant strategy. It is not. It is a recipe for wealth erosion. When you put your money into a typical 401k mutual fund, it is immediately attacked by a swarm of invisible parasites. Expense ratios, management fees, 12b1 fees, trading costs. They market it as a tiny 1% or 2% fee, but do you understand what that actually does? Over a 40-year period, a mere 1% fee can devour nearly a third of your entire nest egg. A 2% fee can consume over half. This isn't passive growth. It's a guaranteed slow bleed that ensures the only people getting truly rich are the fund managers. The financial loop is simple. Your capital works, the market hopefully goes up, but a significant portion of your gains are siphoned off the top every single year, crippling the power of compounding for you while guaranteeing profits for them. You haven't been given choice, you've been given the illusion of choice. These are all just different flavors of the same Wall Street products, fundamentally tied to the same stock and bond markets. When the market crashes, they all crash. It's not diversification, it's redundant exposure to the same systemic risk, and you have absolutely no control. When you see a crash coming, you can't just sell everything and move to cash. You can't decide to buy a hard asset like gold or a duplex down the street. You are a passenger, strapped in, and forced to ride the market all the way down, watching helplessly as a decade of your contributions can be wiped out in 6 months. Finally, we have the most dangerous pillar, the tax deferral gamble. You feel clever for avoiding taxes today, but what you've actually done is trade a known tax rate now for a completely unknown and likely much, much higher tax rate in the future. You are making a 40-year bet that tax rates will be lower when you retire. With trillions in national debt and unfunded liabilities, is that a bet you are seriously willing to make? You don't have a tax-free account. You have a tax-infested account with a massive, growing liability. Every dollar in your traditional 401k has a silent partner, the IRS, and they will come to collect their share when you are older, on a fixed income, and most vulnerable. You haven't avoided taxes, you have postponed them to a time when you will have less power to pay them. So if the 401k is a prison, how do you break out? You don't do it by finding a better mutual fund. You do it by rejecting the entire system and its underlying philosophy. You stop playing their game of accumulation and start playing the game of sovereignty. This requires a new set of rules. Rule number 1, you must build your own engine. Prioritize cash flow over accumulation. The entire 401k system is designed to make you focus on a distant, abstract number, your future nest egg. The rich don't think that way. They focus on one thing: how much cash their assets put into their pocket every single month. This is the only number that matters. The practical application is a radical shift in where you send your money. Instead of maxing out your 401k contribution, you contribute only enough to get the company match, if you must, and then divert every single extra dollar into acquiring assets that generate income now. This could be buying a high-yield dividend stock portfolio in a taxable brokerage account. It could be buying a single-family home in a stable market and renting it out. For example, instead of putting an extra $10,000 into your 401k this year, you use that for a down payment on a $100,000 rental property that, after all expenses, generates a positive cash flow of $200 per month. That's $2,400 of real, spendable income in your pocket this year, not a paper gain you can't touch for 30 years. The common pitfall here is analysis paralysis. People spend years looking for the perfect investment, terrified of making a mistake, and end up doing nothing. The solution is to start small. Your first deal won't make you rich, but it will educate you. Buy a boring, simple asset. Learn the process. The economic justification is simple. A 401k balance is paper wealth. It's a claim on future value. Monthly cash flow is kinetic wealth. It is money in motion that gives you options, buys your time back, and provides the ultimate security that a fluctuating market balance never can. You are building a personal economic engine, not just a savings account. Rule number 2, seize control. Own the asset, not just the paper. The 401k model is built on you giving up control of your capital. To be sovereign, you must reclaim it. You need to be able to decide what to buy, and when to sell. The practical application for this is to move your money into structures that give you direct control. If you're self-employed or have a side business, you can open a solo 401k. If not, you can roll over old 401ks into a self-directed IRA or SDIRA. These are legally recognized retirement accounts, but they function like a financial toolbox. With an SDIRA, you can invest in things the Wall Street system wants to hide from you: real estate, private business loans, precious metals, cryptocurrency. You find the deal, you do the due diligence, and your SDIRA custodian executes the purchase on your behalf. You are now the fund manager. The most common pitfall is recklessness. With total freedom comes total responsibility. Many people get excited and throw their money at scams or poorly vetted deals. You must replace the guidance of your HR department with your own rigorous education. Learn one asset class inside and out before you invest a single dollar. The economic justification is about eliminating the middleman. The financial system is built on layers of fees and commissions that siphon your wealth. By taking direct control, you cut them out. You stop paying a fund manager 2% to underperform the market and instead invest directly into assets where you control the outcome and keep 100% of the profits. Rule number 3, become a creator, not just a consumer. Manufacture wealth. The slowest way to get rich is to be a passive investor, renting your money out to big corporations for a 7% annual return. The fastest way to build wealth is to create it yourself. This means you must stop being just a consumer of the economy and become a creator within it. This is where you build a business. That doesn't mean you need to be the next Elon Musk. The practical application can be incredibly simple. Start a lawn care service, a consulting agency in your field of expertise, an e-commerce store selling a niche product. You buy an asset and improve it, a strategy known as forcing appreciation. You buy an underperforming rental property, renovate the kitchen, and instantly increase its value and rental income. This is an active process of wealth creation. To see this in action, let's look at an anecdote. Imagine two 25-year-old employees, compliant Chris and enterprising Eva. Both earn the same salary. Chris does what he's told. He diligently maxes out his 401k contribution, putting in $15,000 a year. Eva is different. She contributes just enough to get her company's 4% match, about $3,000. She takes the remaining $12,000 each year and in the first year uses it to start a simple online bookkeeping business for local contractors. By year 3, her business is generating an extra $2,000 a month in profit. By year 10, Chris has done well by conventional standards. His 401k balance is around $250,000. He feels secure, but he's still trapped in his job. Eva's 401k is much smaller, maybe $50,000, but her business is now a real asset, generating $10,000 a month in profit, and it's worth at least $500,000 if she were to sell it. Who is wealthier? More importantly, who is more free? Chris has a number on a screen he can't touch. Eva has a cash-flowing asset, control over her time, and a net worth double that of Chris. She didn't just invest, she manufactured wealth. The common pitfall is thinking you need a revolutionary idea. You don't. Most wealth is built by solving simple, boring problems. The economic justification is the pursuit of asymmetric returns. The stock market offers you linear, market-level returns. Building a business or adding value to an asset offers exponential infinite returns because you are creating a new economic engine from your own knowledge and effort. Rule number 4, weaponize the tax code. Stop deferring, start eliminating. The 401k sells you on tax deferral. The sovereign investor focuses on tax elimination. The tax code is not a set of rules to be followed. It's a 7,000-page book of incentives written to encourage specific economic activities. The wealthy don't pay taxes like you do because they don't earn their money like you do. The practical application is to structure your life and your investments to align with these incentives. When you own a business through an LLC or S-Corp, the entire landscape changes. Your cell phone, your internet, a portion of your home and car, these can become legitimate business expenses, lowering your taxable income. When you own real estate, you get the single greatest tax break available: depreciation. This is a phantom expense where the government lets you deduct the perceived wear and tear on a property, even if that property is going up in value. This can create a massive paper loss that legally shelters your cash flow from taxes. Here's a real-world example. A major real estate investor like Grant Cardone publicly states he pays little to no federal income tax. How? He might buy a $100 million apartment building. The IRS allows him to depreciate that building over 27.5 years. This creates a paper loss of over $3.6 million per year. If that building generates $3 million in actual cash profit, he can use the depreciation deduction to offset all of that profit and then use the remaining $600,000 in paper losses to shelter income from other sources. He collects millions in cash but legally reports a loss to the IRS. This is not a loophole. It is a direct incentive written into the tax code to encourage people to provide housing. The common pitfall is fear and ignorance. People hear this and think it's too complex or illegal. It is neither. The failure is trying to do it yourself instead of hiring a specialist, a CPA who works with investors and business owners, not just W-2 employees. The economic justification is that the government rewards creators. It rewards job creators, business owners, and housing providers, real estate investors with massive tax breaks. The 401k is a program for the employee class. These strategies are for the owner class. You choose which one you want to belong to. So now you stand at a crossroads. Before you are two paths. The first is the one you're on, the path of the financially compliant. It's a wide, paved road where you keep your head down, trust the system, and hope that after 40 years of sacrificing your time and your money, there will be enough left for you to live on. It's a path of dependency, where your fate is tied to market whims and the changing winds of government tax policy. The second path is narrower. It's the path of the financially sovereign. It's harder, it's unpaved, and it requires work, courage, and a commitment to your own financial education. But this path leads to control. It leads to cash flow. It leads to a life owned by you, not by your employer or a Wall Street fund manager. The choice is brutally simple. You can be a passenger in a vehicle you don't control, headed for a destination someone else picked for you. Or you can grab the wheel and become the pilot of your own financial life. You can be a pawn in their game, or you can own the board. That choice must be made, and it starts today. Stop the blind contributions that go beyond your company match. Take $1, just one, that was destined for that 401k, and use it to buy a book on real estate. Use it to pay for a course on starting a business. The financial programming that has held you captive for years ends the moment you decide it does. Your sovereignty begins now.